Today we are going to talk a little about foreign direct investment, or FDI for short. Foreign direct investment is an investment made by a company or individual in one country in a business interest in another country. Essentially, it's done in the form of either establishing business operations or acquiring business assets in the other country, such as ownership or controlling interest in that foreign company. FDI theories look into the motivation for foreign direct investment, and they must consider 6 very important questions. Who is the investor? What kind of FDI is being invested? Why are we investing? Where is the FDI going? When do we invest? And how, or essentially the mode of entry. Here are some pretty core theories as to the motivation behind FDI. The first is the capital market theory, which states that FDI is basically determined by interest rates in that particular nation. Dynamic microeconomics states that FDI are really a long-term function of TNC strategies. Exchange rates tell us that the relationship between FDI flows and exchange rate changes are actually very closely related. Economic geography explores the factors influencing the creation of international production clusters. For example, we see innovation to be a bright spot in the Silicon Valley, which brings a lot of foreign dollars into California. Looking at historical FDI data, we see that China has actually been on the rise in terms of outflow of their investment dollars. As can be seen here, over the past decade, Chinese FDI in the US has reflected Chinese FDI globally, meaning it has risen quite significantly. Around 2/3 of Chinese capital targets services, although the industry composition of Chinese FDI in the US has become considerably more diverse in 2015 and 2016. Spreading across a wide range of sectors, the biggest industries were real estate, financial services, ICT, autos, and even entertainment, as well as health and biotech. Going forward, the biggest political downside risks for Chinese investment in the U.S. are related to the political and economic environment not of the U.S., but of China. The volatility in China's markets and continued downward pressure on the currency exchange between the U.S. and China has forced Chinese officials to further ratchet up controls to stop the massive outflow of capital from China. There is even anecdotal evidence that these measures are impacting the ability of Chinese businessmen and companies to conduct cross-border effects transactions, including FDI. Now we're going to take a look at some of the top countries who act as sources of FDI, meaning their cash flows outward as an investment. The United States and China are the global leaders in terms of dollars spent on foreign direct investment internationally. But you can see further down the list, we see economic superpowers such as Germany, Japan, and France. This list is mostly comprised of European countries, but it is worth noting the rise of nations such as Chile and Malaysia. Now, for countries that are recipients of FDI, meaning they take in investment dollars, we see that at the time of this particular set of data, China led FDI flow in terms of developing and transitioning economies, overtaking the United States' developed economies from previous years. This list reflects a balance of highly skilled technical economies such as Switzerland and France, but it also includes markets in which labor is just more affordable, such as Mexico and Indonesia. Economists are always looking to study the contribution and economic impact of FDI on the nations in which it occurs. Increase in FDI leads to higher growth rates in financially developed countries compared to rates observed in financially poor countries. Local conditions, such as the development of financial markets and the educational level of a country, affect the impact of FDI on economic growth. Policymakers should exercise caution when trying to attract FDI that is complementary to local production. The best connections are between final and intermediate industry sectors, not necessarily between domestic and foreign final goods producers. Human capital plays a critical role in achieving growth benefits from FDI. Evaluating an individual nation's potential for fruitful FDI spending can be a very complex process. In looking at this range of factors from wage rates to exchange rates, or labor force and political stability, it really comes down to the experience and intuition of the particular economist who is looking into a country. We know that FDI can be a risky act for any business. But when the research is done properly, we know that it can be a wise choice for a company seeking better labor, a better market, or simply a better economy. Thank you for listening.